Hi, I'm Mark Honeybone with the New Zealand Property Podcast and video series brought to you by Harcourt's Property Ventures. This is a podcast series all about property and anything about property, where I go out and interview the property expert around New Zealand. Sit back and enjoy the show. So welcome back to the New Zealand Property Podcast and video series. I'm Mark Honeybone, and this is kindly sponsored by the Harcourt's Property Ventures. Beside me, I've got here a repeat guest and long-time friend, my Israeli brother, Hadar Orkibi. Some would actually seen him from the last podcast, but many people have known him from previous days and know that he used to invest in New Zealand a lot. He invests in the US mainly now. So I thought it would be a good chance to catch up with Hadar and see what he's done. It's been well before COVID since we last spoke on a podcast together. So welcome along to the show, Hadar, as a guest this time.
Thank you for having me, Mark. That's awesome.
All good. So before we sort of talk a bit about what you're doing in the US, are you still doing anything in New Zealand? Are you still buying properties, or what are you up to?
Yes, Mark. Thank you. I'm still New Zealand, although not as active as I am in the US. I own a portfolio in New Zealand, a mix of multiple income properties in Auckland, and commercial properties as well, which are what we call triple net lease, meaning that we like them. There's diversification of the tenant. So under one property, in that case, for example, I have 4 shops and a residential flat on the top. The triple net lease, it's an American term, which the New Zealand term just ran out of my head right now, but it basically means that the tenant's paying for all the outgoings, which basically means they pay for the insurance, they pay for the rates, and that basically the net cash flow is what comes into your pocket. Obviously, you can't claim it on the residential part of that particular property, but that's how it operates, and that's why I do like commercial real estate a lot. It's easy to operate. It's not tied up to the Residential Tenancy Act, so the communication with the commercial tenants, it's easier, and I like that. So that property is a property that I own for a number of years. It's actually here in my hometown, if you like, in Central Otago, in Alexandra, and it's been a great asset. So that's kind of my buy and hold portfolio, and I also still flip properties regularly. I probably flip anything between 3 or 4 houses a year. I buy houses that require work, and I do most of the deals on my own or with another partner that I have, and he's kind of the project management, and we do a profit share situation in some cases. It's kind of keeping the ball rolling within the New Zealand property market and generating income that way in New Zealand as well.
Yeah, great to see. And well, we've had your story before, but I love your story from coming to New Zealand a few decades ago now, and just learning. Education, it's all about education, and you did that, and you were very, very big in the New Zealand market as a trader, renovator, and investor for many years, and many people in New Zealand got to know you because of that. But in saying that, a few, I don't know, probably you'll tell us 4 or 5 years ago, or maybe even more, I don't know, you decided to head over the shore to the US. I think it helped because you got a passport, American passport, I believe. Don't know if that helps or not. But you do most of your investing there now, and you've had amazing successes over there, and you're helping many people as well. So you can just start off, why the US? What did US have that attracted you over there?
I'll definitely get into that, but before I just share that, I want to say something, just touch on something that you mentioned, and you mentioned that I always like to educate myself and all of that, and we say we are students for life. We always, if we want to be good at what we do, and we want to be the best we can, we always have to keep the education going. And you know what? We're passionate about real estate, so we enjoy learning about it. We enjoy listening to podcasts like yours, Mark, and many others, or reading books, or attending meetups. It's very, very important to surround yourself with like-minded people, and also get the information and the education that you need to take yourself to the next level, to open yourself the opportunities. So I really like that you pointed that out, because I always focus on not just personal growth, but also the business knowledge and the business growth. We always have to learn new things, especially when things change, like tax rules and regulations and different ways of doing things. It's very, very important to keep yourself educated. So thank you for saying that. And I want to congratulate everybody that is listening to this show or watching it on YouTube for actually doing so. It's a great thing. So, I actually looked into the US back in 2008, 2009, 2007, 8, 9, when the global financial crisis was taking place over there with the subprime mortgages. But back then, I had a very strong momentum in New Zealand, and I felt that I wasn't, maybe as an investor, I wasn't mature enough with my knowledge and my confidence to go back then. So fast forward, probably about 8 years since then, 7 years, about 2006, 2018, 17, I felt that for me, I needed to diversify my portfolio. I really wanted to use the opportunity that was given to me. So my mother was born and raised in America. My dad is an Israeli. My mother was born and raised in America. She's an American citizen as well. And I got an American citizenship. So I jumped on like we had in New Zealand. I don't know if it's still available, but we used to have Property Talk, the forum when we all started back in the day.
Yeah, and a few people doing the American stuff and Property Talk. I remember back in those days. Yeah.
So I mean, if you go back and you can see on the other forum in Property Talk, there is a US forum that I posted in 2008, some things when I started doing my research. Back then, I didn't want to go. No, I didn't know if I want to go to single family like houses or if I want to go to multifamily. But when I did some more research on the American version of Property Talk, which is Bigger Pockets, it's a forum, I actually figured out that I'm very interested to go and look into the multifamily sector, which is basically, I'm not going to get into the weeds of it right now, but it's basically being able to buy apartment buildings anywhere, anything from what we have in New Zealand, which is typically a duplex or a plex, which, we have that in New Zealand, what we call a purpose-built, mainly in the 1960s, 70s in New Zealand, even 80s, but mainly 60s, 70s, they were built like those sausage blocks, which I own one in Papatoi, and over the years we owned quite a few in Mount Wellington and all of that, that we traded as well back in the day. And that was very interesting to me because I was familiar with that, and I was always interested in the multiple income property because of the yields, better returns. Not only do they generate better returns, they're also less risky in a way. And that's even in New Zealand, not only in America. When you have, for example, 10 tenants paying you rent, if you have 2 vacant, you can still cash flow, you can still service the debt, and you can still operate without being distressed in terms of financially. When you have one house and it's vacant, you got nothing coming in. So it just makes a lot of sense to me. And the other reason was that I got to the point, going back to your question, I got to the point back in 2016, 17, that I felt that the prices in New Zealand, for me, have increased significantly. And I wanted to try and get a bigger bang for my buck, as they say in America. I wanted to get into a market when the price to rent ratio makes more sense, that it will cash flow, because I really wanted to get to the point when I have a passive income coming in and being able to build a generational wealth with that together.
I guess that's why a lot of people looked at the States at the stage, because when we first started investing in New Zealand, you could buy the minimum we were doing were 8% yields, 8 to 12% yields. And they were anywhere from 150 to 300,000 or 400,000. We knew eventually decided to go. I guess the average price in New Zealand was up to $600,000-$700,000, and you were probably buying a similar thing for $100,000 and getting the yield. So I guess the price point was, I think, one of the reasons that that most people looked at it. I think. So I just jump in there is why. Where did you go? Because I've heard a lot of people and a lot of bad stories. Back when we probably both looked at it back in 2007, 2008. Property Talk, haven't heard of that for a while. It is still there, I think, isn't it? Anyway, there were a lot of horror stories about management. Was the biggest horror story that I heard about places not being managed. So, but they were doing it all around the States, a lot of different places. Where have you gone, and have you just cemented to one place, and why that area?
So first of all, when I decided to go and invest in the state, I actually did my market research. We like to look for markets. I'm focused on two, three markets right now. Like basically, one market is my primary market, and I got another market which I'm operating in. But on a nutshell, we're looking for markets that have job growth and population growth, or maybe a steady as she go market, which makes a lot of difference. Like, I'm not going to get into a conversation now that really covers the whole economy or real estate economy, different markets. But what I can tell you is, generally speaking, there are markets in the States which are more favorable to investors. For example, the landlord-tenant laws are very favorable towards the landlord. You can evict people if they're not paying within 30 days. For example, I give you an example, Texas or Arkansas or Tennessee or Florida, or some market, they are much more pro landlords than tenants. And that's typically the southern states, the cowboy states. The landlord, the cowboys, the kind of state, the southern
landlord
state
comes into town and everyone sort of
right. If a tenant is not paying rent, after 30 days, you can call the sheriff and they can actually, there is a process that you need to follow through. Each state is different, but some state you can actually get the sheriff to come out and kick them out. And he's not coming with guns and a hat, but some of them might do. But it's a very, very landlord-friendly state, which is one of the advantages that I like. Here in New Zealand, it's pretty strict on that matter, which there's a good and bad for it. Some states in America, like the northern states, or for example, New York, California, places like, for example, Boston, Seattle, those are cities. They are very, very, the northern state, they're more like the union, they're more like pro tenants, and you got rent controls and you got things which will make it very unfavorable for investors. So having a landlord-friendly state was the #1 criteria. So after that, I looked for the metrics of job growth, population growth, which again, if you want to find the right state, for example, if you go to a state that has a massive job growth and population growth, that state, for example, Texas, Dallas, Texas, it's already bolted by the time I looked over there, or the areas of Jacksonville, Florida. The market already everybody already knows that the population growth and the job growth is increasing significantly over there. So there wasn't enough opportunity for me to go there because I missed it. If I would have came 2 or 3 years earlier, I could have gotten on a good price before it was known to everybody. A lot of states have their own governors, obviously, all of them have, and the states themselves decide if they give tax credits for certain businesses to move in, and there's a lot of encouragements to do business in a lot of those states that you have a job growth and population growth. So we looked for those states, and one of the states that I invest in, for example, it's more of a steady as she goes state. It was a little bit under the radar when I moved in, and it's Arkansas. So I invest in Arkansas and Tennessee, and I'm also interested in other states, but my main investments are in Arkansas, which are the multi-family. I own over 200 units over there. It's about 100 and something units on my own, and a few others with 2 or 3 partners. And in Tennessee, I own another beautiful asset class. I own mobile home parks. Mobile home parks are a great asset. We try to buy the parks that basically you own the dirt, and the residents there, they own the home. So you don't have to maintain the house, they only pay you ground rent, so it's really, really profitable. The expense component is pretty low. All you need to do is cut the grass and pay for the management. So how did I find a good management company? Again, I've done a lot of research. I was prepared to commit and travel 2 or 3 times a year, network over there. I even joined the coaching program over there that really helped me to get educated with multifamily. That was in 2016, I believe, from memory. And that helped me to really get the basics. So I read a lot of books, I listened to a lot of podcasts, and then I joined the Jake and Gino, the mentors, my mentors, and I really learned a lot from them. So that allowed me to get educated and make the right choice within also a community that if you have a question, you were able to answer, or referrals. And that's when I landed in Arkansas. I traveled there. I liked the place. I drove around it for about a week or so, and I felt that it's easy to understand. For example, Memphis, I also went to Memphis. For example, Memphis in that case, block by block could be different demographic. You can have one block that is rough and it's war zone and you won't want to go there, and one block next, it will be a good area to invest. So you really need to know, and you really need to have strong boots on the ground. What I felt, for example, in Arkansas and the other markets in Tennessee that I invest, for example, Nashville, I was able to find a good boots on the ground management company. I made good friends. I got my feet wet with the 3 units, then a 4 units, and then I actually ended up doing a lot of direct to seller campaigns. And I managed to get some deals off market, which were very profitable. I bought 45 units and then 57 units and started growing the portfolio in a way that allowed me to actually buy those assets under rented. They were under rented. I was able to renovate them through, when I did the 3 and 4 units, I was actually got myself a network of subcontractors. So I leaned on the property manager for some of the things that needed to be done, some of the work. For example, painters, for example, heating and air system. They had good deals with that, so I went with them. But some things I got them to get some quotes, and then I went and shopped around, and I went to meetups over there. So I met other fellow investors, and I basically was able to get other quotes and other bids, as they call it in America, and was able to really control the pricing and get familiarized with how much things are cost, put it in a spreadsheet, and really was able to then scale the business really fast. And I want to mention, Mark, that the reason I like multifamily so much is because you buy one asset and you buy 20, 10, 20, 40, 50, 120 doors in one transaction. We know how hard is it as an investor to find a good deal. So if you're able to find a good deal after
one transaction, one negotiation with a bank,
one negotiation with the seller, one negotiation with the bank, you have more often than not, you might have 20 units under one roof. If anything goes bad, you have one roof to replace. It's very centralized, and it really allows you the economy of scale to scale the business. And another very important point with specifically multifamily is that when you buy in America, when you buy 2 to 4 units, these are regarded as residential. Their landings and their values are determined by comparable sales. This house sold for this, this house sold for that, like we do comps as a real estate agent, like you do. The CMA, comparative market analytic. So a fourplex will say, let's say 30, 40, 50,000 per door, and that's kind of the comparable. When you buy 5 units or more, they value the properties based on the net operating income. So if we buy an asset that has what we call a loss to lease, meaning that there is an upside in the rent, let's say there is a certain amount of rent coming in per month or per year, and let's say you have a 15% upside, meaning that you can increase the rent by 15% to the market because it's below market by 15%. That's a loss to lease of 15%. That's simple. So it's really easy to find. Well, it's not easy to find the asset, but it's really easy relatively to force the appreciation by buying an asset that has deficiencies, let's say a loss to lease or mismanaged. We look to buy a lot from mom and pop owners who don't have systems and processes. They own the property for 30, 40 years or 20 years. They manage it themselves, so they feel obliged to the tenant not to increase the rent. And if we're able to pick up those assets and increase the rent by $100 a door or $200 a door or do some renovation, then do that, suddenly when you increase it by 100 to 200 a door over 20 properties or 50 properties, the income is increasing significantly, which reflects net operating income, which reflects a higher value. Typically, we can turn those properties around within 12 to 18 months or 2 years, depends on the size. Yeah, and it also depends on the leases. So when we buy the property, we do a due diligence. We teach in the mastermind. We have the 4-stage due diligence process, which is the online due diligence, financial due diligence, That's when we review the profit and loss, the P&L, and the trailing 12, which is the trailing 12 of income and expenses. And you review the leases, and you can see where the leases are maturing. So then you can actually have a plan to increase those rent. So that's kind of what we call the stabilization plan or the repositioning plan. We take the property for where it is and we reposition it to be stable. So increasing the rent is one thing. We can also decrease expenses. How do we decrease expenses? I'm going to give you only one example. The one example, a lot of those properties that have been built in the 60s, 70s, 80s, even in the 90s. I got one which is a 1997 built, 3 buildings, 36 units, 12 units a building. They have a master water meter for each building. So each 12 units are under 1 water meter. The previous landlord pretty much paid the water himself, and that's it, and only collected the rent. Now what we do, and it's a common practice, not every state, you need to know your market, is we bill back for the water usage. For example, a 2-bedroom apartment, we can bill back $45 to $50 a month. So if you have 50 units, that could amount to a refund from the residents, from the tenants of $20,000 a year, which will affect your net operating income. So that's why I'm so excited about it, because there are so many opportunities to add value, which allows you to basically do that and repeat. Once you add the value, you refinance the property. I've done a transaction when I was able to take all my money out. I sold the property in New Zealand. I brought the money to America. I bought the property, used it as a down payment and some of the renovation budget. And I was able, after 1 year, to refinance from one lender to the next one. I took all my money out. And then I kept doing the job, and I got better terms as well. So I get lower interest rate, higher amortization. Over there, you can get 25-year amortization. You can get anything from 3 to 5 years IO, interest only, and you can get a 30-year amortization. So the first refi, I got all my money out. The second refi, after 2 years, I got another $500,000 out, which allowed me to have what we call the velocity of money, which is basically taking the capital that you invested into the deal and shift it into the next one. Now, another beautiful thing that I like to share with you, Mark, is that the second refi is gone to, you might have heard about it, to what we call Freddie Mac debt. Freddie Mac, you got Fannie Mae and Freddie Mac. These are, on a nutshell, agency debt, which is backed by the government, and that particular debt is a non-recourse debt. So it doesn't go on your balance sheet, and in a way, you're not liable. You are to the performance of the asset, but it's a non-recourse debt in many ways. So when you go and borrow more money or you want to grow your business, it doesn't show on your balance sheet because it's a non-recourse debt. So there's a lot of opportunities in America. It's not easy to get into the market. Kiwis, for Kiwis, if you don't have contacts over there, if you need to start from scratch, you really need to get educated, and you really need to basically join a team, or like Hun and Ian and Liz and Jared from Palmerston North. We got in the mastermind, we got I think we had 4 or 5 members who are Kiwis, but the main goal was first to get educated, maybe invest in a smaller deal, learn the ropes, and then slowly get into joint venture opportunities with local Americans within the mastermind, within the network, because it's hard to go and borrow money if you don't have the relationship. You can still do it, but the lenders will only lend you like 50% of the money. So you have to bring them up. Basically they're de-risking your exposure.
Great stuff. That's awesome stuff. And if people are interested, which I'm sure they will be, we'll do a bit more, have another podcast just on the US market over there. So let us know if you do. Hey, just a word that I know you have to go soon, but it's just a word that come up a few times there as a mastermind group. I know you've I think joined the people that taught you. You're now a part of that mastermind team of doing education over there. I know you've got to go soon, but just a couple of minutes on that again. We can talk about that more in the next time we speak.
Yeah, so on a nutshell, actually the people who coached me saw that I'm so committed and
you are to anything you love.
Yeah, well, and focus and committed and make it happen. Making it happen from New Zealand. So they actually asked me to coach for them. So I became a coach for Jake and Gino, and it was a great experience. great mentors, and their community is great. But while I was coaching for Jake and Gino, and I was coaching Americans, hey, if you live in California and you want to invest in Alabama, don't give me an excuse that it takes 3 hours to fly, because I'm flying from New Zealand and it takes me 14 hours to Houston only, not to mention the drive to Queenstown. So, so that was kind of the approach. And when I joined Jake and Gino, I used to go every year to the conference. And then I met Marco, who is my business partner. And we started the MIH Mastermind. It's totally separate from Jake and Gino. We actually had quite a few Jake and Gino members coming to us as well to keep up the momentum, because we are actually focusing on quality over quantity. We kind of focus on having less people. We always available for our members, and we created the MIH Academy, which is an academy. It's an online platform on our website, which is MIHmastermind.com, and members have a login to the academy, and they have all the education there. So we teach them how to analyze multi-family deal. We really teach them all the nuts and bolts. Typically, we don't take beginners, so we take people with some experience in real estate. Like everybody from New Zealand, for example, and most people who joined from the States as well, they had some real estate exposure as a general, probably with single family, with houses investing, and they want to scale up to multi-family. So Marco and I started it. Marco is Gino's brother, and he owns close to 3,000 doors himself with Gino. And we started the mastermind, and we started it just before COVID. So that was quite a good timing for us. And we have about just around 200 members in the mastermind. We do every year. Now I'm going to, as you know, going overseas this weekend to Florida. We do the MIH meetup over there. So people come. We have the presentations. We go out for some good meals, and it's 2 days. And we teach them. We teach them multifamily. But the most important thing is the system and processes that we like to put down on the table, and we teach them how to go typically from M to Z, not to A to Z. We like to take people who are kind of not beginners, to take them from M to Z, and we teach them how to analyze those deals. We give them the MIH underwriting course. Underwriting means to analyze. So that's one of the first things. We create what we call the quarterly action plan. So we give them 3 focus areas, and we make sure that in the first 3 to 4 months they join the MIH Mastermind, they focus on specific things. Typically, it will be education, it will be networking with MIH members, and it then will be something else that they need, perhaps creating deal flow, perhaps finding a team within MIH to join and adding value to the team, which you can do regardless where you are. There's many things that you can do if you're not located and you want to buy the property, like to be boots on the ground. There are a lot of people who from New York and California who collaborate with people in Alabama or in Florida or other places in different way. So on a nutshell, we teach also the 3 pillars of deal flow, which is one of the keys. And the first one is what we call broker relationships. So on and off market deals, we teach them how to stabilize the relationship with the brokers in that controls the deal over there, how to talk to them, how to give them feedback once you analyze the deal. You want to make sure you do it correctly. So the first one is broker, the first pillar. The second pillar is direct to seller. So we teach the whole gamut of direct to seller from voicemail drop, cold calling, letters, you name it. And the third one, which is very, very, very important, they're all important, is the networking. A lot of MIH members doing deal together. It's like an ecosystem of deal finders and people who can bring capital to the table. And we really put them together. We introduce them to each other, and of course they need to make sure that they vet each other properly. But that's how we help them to pick up momentum and help them to build what we call the passive income generational wealth. So we don't use the word some words which are kind of pie in the sky. We like to use the word financial independence, because once you reach financial independence, you have freedom. And if you have freedom, you're able to do what is really important for you in your life. You're able to spend more time with your family, and you're able to add value to the community as well.
Yep, great. I love those 3 pillars. It's a bit like being a good real estate agent, actually. So that's great. Hey, that's absolutely awesome, Hadar, hearing your sort of story over there. And as I said, if people are interested, certainly reply to us through this, however you've listened to this podcast or watched it, and let us know, and we will do a more detailed approach and effort for US, investing in the US as a Kiwi. I love your passion, mate. I always do. You're passionate what you do. You're good what you do. You help others, and you're a great person because of it. And that's why I love having you on the show as much as we can. So we will cut it off there. I know you've got to go and get a blow wave or something for all that hair you've got. Get a yellow cutter or something. and we'll look forward to having you back on the show again, and certainly looking forward to having dinner with you on Sunday this week. So thanks very much, Hadar. I don't know if there's anything else you want to say, but I'll say thanks, listeners, for watching. Have an outstanding week, and we'll see you next time on the New Zealand Property Podcast and video series.
Stay tuned. See you soon, and make it happen.